We had the right product in the right market at the right time. We're hitting all of our numbers. And this exogenous event, this thing we had zero control over, literally shut the business down in an afternoon because all of the banks just stopped putting money out on the street. And that was our lifeline. Like we needed that to continue to make loans. So, I get out of that meeting and I've got a zillion text messages and voice messages. And we had 50 something employees at that time. And they're like, do we still have a job? What are we doing?
From scrappy founders to 8-figure success stories, we're busting startup myths, getting raw insights from market-tested entrepreneurs, and revealing the proven playbook for bootstrapping your B2B startup to 5 million. This is the Startup Different podcast. Robert Levin is a seasoned investor and operator with a robust background in strategy, growth, and mergers and acquisitions. His roles have included serving as the chief investment officer for L2L Capital, a Hong Kong-based family office, and a number of other large growth firms. Today, we talk VC, funding, and more on Startup Different. Hello, folks, and welcome to Startup Different. I am David Singleton. With me is the lovely Christopher Singleton, and we have another person with us today, Rob Levin. Rob, how are you doing? Thank you so much for joining the program.
Great. Thanks for having me on.
So, Rob, we just did like a big intro to you. You've had a really impressive career so far, both as like an operator and an investor. You've exited business. You've kind of seen quite a bit. And when I think about our audience today, I think they can actually learn quite a bit from you. So I want to make sure we're picking your brain as much as we can today on some of those important startup principles, some of the things you've seen. But to start things off, can you maybe set the table a little bit for folks so they can understand, who you are, where you came from, and how you've gotten to where you are today?
Sure, happy to do that. So I started my career in a much more traditional way. I was an employee for a Fortune 200 financial services firm when I was just starting my career. Thought that was the path that I wanted to take, and it was very interesting for the first 15, 16 months as the company was actually getting ready to go public at that point. So it was privately held as a large mutual insurance company with a whole bunch of tentacles across the financial services space. And I was involved in the process of helping the company go public and get out. So it was very project based. It was very exciting. Just thrown into the deep end, learning a lot about what makes a company like that tick. But once the IPO was over and they started to integrate us back into what I'll call normal jobs, it became pretty clear pretty quickly for me that I wasn't really cut out or happy to be employee number 13,212 at a
I can't imagine why. That sounds so glorious. Was that your title or
yeah, exactly. I wanted that number to be a little bit lower on the on the employee count.
Yeah,
side.
If you work really hard, you can break 10,000. So
that's right.
That's exciting. Cool.
And the other thing was, the job was, the full-time position when I was doing the IPO piece, there was a lot of travel and going back and forth. And then when when all of that sort of came to an end, the other side was I would have to move to Des Moines, Iowa, which, no shade
disrespect to Iowa, but
no shade on Des Moines. It's a very nice place, but I was like, late 20s, just kind of starting my career. I'm like, man, I don't think, and I was born and raised in the Northeast, Philadelphia, New York, went to school in Boston. So I was used to a little bit different lifestyle. So Des Moines wasn't really in the cards for me at the time. So I think, honestly, if we kind of pull through my, entire entrepreneurial and maybe even investing career, I think that entrepreneurs, somewhere deep down inside them all have this trait of see a problem, solve a problem, right?
Yeah.
And it just drives you crazy. Like you see something and you just, you just can't let it go. And you're just like, I've got to fix this. Or, like some of the, you've seen some of the best, necessity is the mother of invention. Some of the best things come out of like, I would really like this. And you look around and you don't see that. And so, a lot of people just sort of, write that down and go back to their job. And I think people who have that sort of entrepreneurial gene are just like, well, then I'm going to create this, or I'm going to solve this, or I'm going to do this. And I think that was always kind of, sort of deep down inside of me. So when I left that position, I refer to myself as the accidental entrepreneur because, when I was sort of coming up, entrepreneur wasn't like it is today, right? I mean, it wasn't like entrepreneur was like, well, nobody will hire you, so I guess you have to go start a business or do something.
That's called fun employed, I think,
Yeah,
is kind of
exactly.
where you're at there. Yeah, for sure.
Exactly. But there wasn't sort of it's obviously been around for forever, but it didn't have sort of the same cachet or, everybody sort of saying, I want to be an entrepreneur, I want to be a founder, I want to do my own thing. So there was, I don't say there was a stigma around it, but it certainly wasn't something that I came up saying, I'm going to be an entrepreneur someday, I'm going to start a business. So that's why I always say I was more like an accidental entrepreneur. And when I left that financial services firm, I, ran into a very unique situation with, a person I was introduced to, where they had been doing a lot of acquisitions. They were in the pharmaceutical space, and a lot of pharmaceutical companies, their R&D pipeline used to be acquisition, right? They used to just make a lot of bets, and then if one of those bets paid off, they would just buy the company. And so when they would buy the company, they would get all the other detritus that came with the company outside of the idea, people, pension plans, insurances, all that other stuff. And they didn't really want any of that stuff. They just wanted the IP or the product. And they had been doing a series of these over many, many years. And they had, woken up, sort of one day, and they're like, we have all these pensions, we have all of these retirement plans and insurance plans, and we don't know what to do with them. And we just keep paying, making contributions and paying them. And I had no idea how I was going to do this, but it sounded like a problem that I could.
Hey, we're taking a short break to tell you some exciting news. Chris and I wrote a book. Surprise! It's called Startup Different, the myth-busting blueprint for your multi-million-dollar business. And it's available now. Like our show, we're trying to pay it forward to our fellow entrepreneurs. The book busts 33 business myths, tells some of our most hilarious stories, and gives you many of our best tools to build, scale, and exit your business. You'll find the book on all major online retailers, including Amazon. Check it out. We think it's pretty great. And now, back to the show.
Solve. And I just said, why don't you let me take a look, and I'll give you a report that says, what you should keep, what you should get rid of, how you should get rid of it, what you should, hold on to. And he's like, great, send me a proposal, and, we'll take a look. And so I had lesson number one out of that experience, which I sent him the proposal, thinking I'm going to ask for this huge amount of money and see what he says. And I think it was maybe 3 hours later, he got back to me and says, okay, you're hired. Right. So I was super excited. I'm like, this is great.
That sounds like a pretty great scenario.
I was like, wow, this is awesome. Right.
I'm such a good entrepreneur. Look at me. I'm closing deals already.
Yeah, look at this already. But what I realized was I actually called my dad, who was an accountant, a partner in a big accounting firm. And I was super excited about it. And he goes, okay, lesson number one, you didn't ask for enough. If they said yes that fast,
you left money on the table.
You left money on the table, 100% for sure. And he's like, but now you're hired. You got to do the job at that price. So I was like, okay, cool, I'll do this. And again, I had no idea, what this entailed. I just sort of had, this notion in my head. And back in those days, there was email and stuff, but it wasn't like it was today. So they sent all of their paper boxes. We got these delivery from this company called Pierce Leahy, which is like an archiving service. I don't know, must have been 40 boxes full of paper that was delivered. And they're like, okay, here's all our stuff. Like, go through it.
Oh my God.
I know. That's exactly what I said.
It's funny. Just quick segue. It makes me think of Centrifile. Chris had a product before he and I teamed up, and that it was all about this. It was just document management. You just scan it, and then you would automatically OCR it and upload it and organize it. And it was like pretty, I think it was ahead of its time. So, you could have used, I think what did it cost, like $3,000 to get one of those licenses. So there you go. That could have been a solution for you.
You were a power user.
I was. Yeah. We referenced this previously. I had one magical summer at our dad's photocopier business where I scanned 20,000 documents or something. Anyway, we digress. Let's go back to the box.
No, that's okay. So I get all these boxes delivered to my house because I didn't have an office at the time. And I
Yes.
realized like, I definitely in over my head here. There's no way I'm going to be able to go through all of this stuff
Yeah.
and figure, and figure this out. So um, second lesson was like, so I had to go hire some people or recruit some people or get some people to help me with this thing. And I did. I got a couple of guys, two people to sort of help out. So now that big payday was now split in three, right? Or at least had to be, going to that. And then we realized very quickly, well, we need to get an office. We can't be working out of my house. So we went and rented some space. And then eventually we had to hire a third person, an assistant, to just go through stuff. So we went through this project. It went fast forward. Okay. It went well. We did a great job. But I realized we were so head down in this thing that I realized that as this thing was coming to an end, you woke up and like, wait a minute, I have employees, I have rent to pay. We need
Yeah.
another customer. like,
Yeah. Cool.
we weren't even thinking about what we were going to do after this. We were just like, let's get through this project. And then, so very quickly, I went out and luckily, we got a couple of referrals from, he was a pretty, well-known guy who had hired us from this firm. So got a few referrals and, we're off to the races. And that business ended up growing. We had about 30 employees, and then it was
Oh, wow.
acquired
Wow.
by another financial services firm about it was a little over 3 years in. So and it really the acquisition came out of the blue. I had no idea that the people I was going to meet with wanted to buy the business, but we sat down at lunch one day and they're like, "Hey, we want to buy the business," and I was like, "You do? Why?" Like,
Yeah, cool.
yeah,
Wow.
like,
That's
are
pretty
you?
sweet. But I love if we just go back for 1 second, I love this accidental entrepreneurship because you totally backed into this. You didn't even kind of realize that you were starting a business. You were just like
Right,
dealing with a problem. You know what I mean? Just
exactly.
solving a really complicated, annoying problem that was valuable to someone else. And I think
Yeah,
that it's so funny because I feel like nowadays you see a lot of entrepreneurship where the entrepreneur they have a technical solution that is then looking for the problem. And I've said this I
yeah,
don't have anything like really against crypto, but crypto feels like the ultimate version of this. It's like
yeah,
this, we're out here, we have a thing, we just need to find the problem that we're best at solving, and then everybody will do it. So
yeah,
it's interesting to me that you kind of just did this sort of backwards. You just kind of like fell
yeah.
right into it. So
Yeah, no, that's it. And I've sort of kept that perspective, all throughout, but also, we'll talk about this, I'm sure in a few minutes, but I've also taken that perspective from the investing side of things. And so it's like, I think it really boils down to, people, will pay for one of two things, either to solve a problem that they have or to do a job they don't want to do. I mean, it really comes down to that, right? And if you're not really hitting on one of those two things, and there should be some unique way that you're doing it, but we can talk about the sort of the way that you sort of look at growth, but it really boils down to that. It's no more complicated. So you're right. I mean, I started with there is this problem, and like, okay, I think we can solve this problem, and it turned into a real business that I was saying ultimately got acquired. And when this was like the second lesson out of this first business was, so they approached and they said, "Hey, we want to buy the business." They had a number. They were serious about it. And I said, give me 24 hours to think about it. But I kind of left that meeting going, of course I'm going to sell. Like, why not? Like, this is,
yeah.
but you have to be cool and play
Yeah,
it cool.
well, Chris didn't. We can talk about
Yeah.
that another time later. But Chris did not play it
Is
cool.
that right?
Here we go.
Dave's gonna tell his favorite story.
It's all good.
Okay?
It's all good. We'll come back to that later. I
That's
don't
all
want to distract.
right.
Yeah,
Got a little excited.
yeah. Basically,
Um,
okay, cool.
but so I went back and I talked to a few people, and they're like, "Well, if they're interested, maybe you should take it to market, and you should do this, and you should." And in my head, I was just like, "It's a win, right? I'm going to sell this thing. I'm going
Yes,
to put some money in the bank. Can't take
totally.
that away from me." I see a lot of this with entrepreneurs today. It's like, they're trying to optimize down to the penny of what they're going to get. No, it's like, at some point you just got to say, look, it's a win, right?
Yeah.
You now have that in your back pocket. Nobody can take it away from you. You started a business, you sold a business, it was acquired. There's value in that, going through the experience. And I don't want to dismiss the money making aspect of it, but at a certain point, we were only operating for 3 years, and the money was enough for me to be like, okay, this is great. I'm going to put this
Yeah.
away. I'm going to have I'm going to count it as in the win column,
Yeah.
and then we'll see what's next. The only downside of that deal, in retrospect, and it didn't, was I had obviously a 2-year contract that I had to fulfill with this firm.
You had an earnout. You had a 2-year earnout, basically.
At an earnout with certain milestones, which is totally fine.
Yep.
But it put me back into a 12,000 person financial services company again.
Yeah,
and
right.
so one, I knew that I was gonna just stick it out so I could get my the rest of the money. But it also just totally reinforced for me, being back in that environment, that I made the right decision, and this is not my career is not within one of these big firms again.
That's funny. I worked for a large telecom, and then after that, we started the company here with Chris. Went through that process, sold our company, and then we joined a 250 person company. And then after that, we joined like a 20,000 person company. We were actually acquired twice in a very short amount of time, relatively speaking. And as soon as I hit that, I got my employee number, and I got like the log. What was the HR software? ADP or like one of the. I got the ADP. I'm like, oh man, I've been down this road. Okay, but I actually think that was really interesting about counting that in the win column. The acquisition that you did have, obviously it's in the millions. It's a significant value. That's great. I can see, Chris, you were nodding like the whole time. Did you want to jump?
Well, that was kind of the thinking I had with our first ovation to sell our business. I was like, hey, this is a win. We should roll with this. Like, this probably won't happen again.
Yeah.
At least not with this business. Like, we may have another business that we start afterwards. But and so I kind of know how Rob felt.
Yeah, I think that was interesting too. Like, obviously you try to maximize the value, but there is a certain point of this, and this is a super. I'm going to get hit for this one, but what's another $1 million on top of what you are already making through that deal? You've optimized pretty well. It's a good deal. It's a win that you can rack up. It gives you flexibility in the longer term. You don't have to keep running the business, and also trying to figure out how much your business is worth later. You know what I mean? Is this ridiculously annoying game? You don't know. And I've said, this is my analogy for you. You don't know when a global pandemic is going to happen. On the other hand, you don't know if Taylor Swift is going to wear your company t-shirt, at a Chiefs game or something. You don't know where it's going. You have a sense for it. You think you've optimized it as well as you can. And you went for the payday, and there's nothing wrong with that. I think that's pretty interesting. So
and I think that lesson pulls through to a lot of other things that you do in building a business, which is 80 to 90% is usually enough. I see so many people trying to optimize to that last 2%, which is really not going to move the needle at the end of the day, right? It's a little bit about the MVP, and if your first product doesn't suck, you ship too late and all that stuff. It's sort of the same thing. It's could I have squeezed another 5% more out of the deal? Probably, but one is I risk losing that deal, right? So there's always that, I have when we go on you talk about M&A and investing, there's this old adage, time kills all deals, right? I mean, it's the longer you drag this out, so I after being at that, in that business for 2 years, we hit all of our numbers, we got our earn-out. And it was just very clear, as my time there was ending, I was going to go out and, start another business. And I think everybody in the company kind of knew that. When I told them I was leaving, there's nobody who was shocked, to learn that I was, was going to go out and do something else. So, I started another business after that, which was, I would say it was not, going back to your point of you never know when there's going to be a global pandemic or, some crazy, external event. I started a business in the specialty finance space in 2006. which sounded like a great time to do it. Again, you see a problem, solve a problem. And we were not in the mortgage, CMBS, that space directly, but indirectly, all of the banks that we were working with were.
Yeah, your customers are obviously in that space.
No, it wasn't our customers. So what we did was we were making working capital and operating loans to mid-sized businesses. So there was a gap in that market because all of the bankers were chasing mortgage deals, stuff they could securitize, and there were all these great businesses out there who would be saying, like, we can't get our banker on the phone, like they will not pay attention to us. And then when you talk to the bankers, you're just like, why aren't you paying attention to this really nice business over here who just needs some factoring or working capital line of credit or operating line? And they're like, well, we can't securitize it, we've got to hold that thing. And our mandate, and talk about alignment of incentives, our mandate from the top is we need to package this up and sell it off to Wall Street, because that's where we're making all the money. So again, there's a gap in the market, saw it, but it wasn't that the banks were our customers. The banks were our suppliers. So we were actually borrowing money from the banks and their what they call commercial paper markets, and then taking that money and making these loans with it. So if you want to talk about a funny kind of fundraising story. So I didn't raise any money for that business at first. I knew we would have to raise capital for it if it got, kind of at scale, because we just didn't have the balance sheet to do it, and I wasn't gonna do it. So I started to meet with investors, and as we talk about the fundraising aspect, this may be, just good fodder for folks that are listening. I was given some really good advice. It's like, start meeting with them way before you want money. Right. And go and start just telling them about who you are, what you do, what your plan is, and then just keep them appraised as you go. Like, hey, just want to let you know we hit our targets this month, or hey, we're over this, And I have a very good friend who is still a partner of mine in an investment that we're doing, or that we've done. And he gave me this great advice one day. So I can't claim credit for it, it's his, but he's like, his advice was, if you want money, ask for advice. If you want advice, ask for money.
Right. I've heard that before. That one I've definitely heard before. But the first one was interesting, though. Building the rapport is kind of a cool idea. Well before you need the money. It's kind of interesting.
Well before. So by the time you go in there, they're like, yeah, we got it. And the process is, we know about your business. We know you hit your targets. We know what you're doing. You just keep them in praise, and you just send them a quick note, once a month, once a quarter, whatever. And so by the time you're ready to raise money, and you keep telling them, we're not raising capital now, we don't want money, I just want you to know what I'm doing. So by the time we were ready to raise money, the process went pretty quickly, because we already had established relationships with a bunch of these guys. And so the morning that I went to the closing, it was really just a formality. We had been through investment committee. We had been through, it was a big private equity firm in headquartered in New York. And I was traveling up from New Jersey, so I was taking the train, and I was just getting ready for the meeting. I was on this will tell you when it was, my BlackBerry at the time.
We're in Canada, right? So
I know, so you guys know all
Let's go.
It's on my BlackBerry, and I was reading some stuff, and I was just heads down, and I come out of the train station in New York, and I go over to their offices, which were, in the GM building, go up, and they had a combination of like a private equity firm and like a trading group there. So big open floor, big glass, conference rooms. And I noticed, you walk in, and it was just kind of like there's something off about it. Like something was like not quite right. Yeah, there's
the air all of a sudden.
Little distraction going on. And I was just there to like meet the partner, shake hands, and then arrange the closing. And, I was going to my lawyer's office afterwards. That morning was Lehman's bankruptcy.
Wow.
While I was on the train.
Did it close? It didn't close.
No,
did it close?
No, it did not close. So no.
That would have been the sales deal of the century.
That would have been
that deal.
Yeah.
Wow.
No. But it's literally like one of those things that, first of all, you'll never forget something like that. But two, we did everything right in the business. We had the right product in the right market at the right time. We're hitting all of our numbers, and this exogenous event, this thing we had zero control over, literally shut the business down in an afternoon, because all of the banks just stopped putting money out on the street. And that was our lifeline. Like we
Yeah.
needed that to continue to make loans. So, I get out of that meeting and I've got a zillion text messages and voice messages. And, we had 50 something employees at that time. And they're
Oh
like, do we still
man.
have a job? What are we doing?
Yeah. The panic, the mayhem from that must have been crazy.
It was insane. I mean,
Yeah.
you can only imagine. So,
Yeah.
I always like, there's this sort of myth that goes along with entrepreneurs that it's this great life and it's going to be freedom and private jets and cover a Fast Company magazine. I'm like, it's not like that at all. I mean, you guys, can appreciate, but that was the hardest 18 months probably of my career, was trying to kind of wade through, what do we do with all these employees? We still had hundreds of loans on the books that we had to service and had no revenue coming in. And just trying to figure out a soft landing for that business if we could. It was a little bumpy, but it took a while to work that out. But that was the perfect example of, there are just some things in the world that you cannot control, a pandemic, a financial crisis, and you can do everything right and still end up with nothing at the end.
I love this. That's it's obviously like a terrible story on the one hand, but it's also like an amazing story, because I think there's something to be said about, again, you just don't know what it's worth, and that kind of thing can happen and just totally upend your business. Now, I think that was, Chris, you're a bit more of a pessimist. I kind of feel like this was always sort of maybe not that intense. That's an epic story too. That's an
why
incredible
I liked his story about like, hey, I got one in the bag here. Let's just take it.
What is it? One in hand's worth two in the bush kind of thing. Like bird in hand, or something like that. It definitely has that vibe. Seriously. Rob, we've covered a ton of awesome stuff. It's actually been really interesting. Normally I ask about 4 questions. I've just been enjoying listening to you go. I have a couple of small questions for you. And then I want to get to our startup myth as well. Although you did just hit one, which was really good. So maybe we call it that. We'll see. But, this is kind of silly. But you mentioned, so being this like accidental entrepreneur, going back to that just for 1 second, do you think that it's kind of like one of those entrepreneurship questions? Do you think you're like born with it, or is that something that you can develop? Because to me, you're giving me like born with it vibes. You know what I mean? Mm-hmm. I'll tell you how I land on this in a second, but it's interesting to hear you, or just like the way that you describe how you attack these problems and how you went into these businesses and all this stuff. Like you're a very active entrepreneur, despite the fact you being like an accidental entrepreneur. So what do you think about that for the people listening today? Are you born with this? Is it something you can develop? Like what's your take?
I think, so it's the whole nature over nurture kind of thing. And I think that there are parts of it that you obviously can develop. I mean, this is not something that, you could only do if you have, sort of the innate DNA. But I think that there are certain characteristics, certain profiles that are more prone to go down the entrepreneurship route, and certainly more prone to be successful as an entrepreneur. Mm-hmm. You've got to be comfortable with risk. You've got to be comfortable with uncertainty. You've got to be comfortable with, difficult situations. And I think, if you can't kind of get your head around those things, and, you're just better off, as an academic, or you're better off in a big company where everything I do work with and counsel, and advise a lot of entrepreneurs and aspiring entrepreneurs. And, one thing that I would say is like, you really, really, really have to love it and believe in it, because, it is not fun, especially early. Like,
we're trying to be like, we're very positive on this show, but I like that. It's not fun.
No, I mean, but I'm just trying to be honest and realistic about it. It's like, during that first grind, it's like, you guys have started a business. I'm like, you, like I said, like we were like, how are we going to pay the rent? How are we going to make payroll? Like, how are we going to get our next customer? Like, what is this going to look like? And then, we can talk about transitioning into, then you go raise money and you think, okay, everything's great now. And it's just a different dynamic now. Like, maybe you're comfortable, you're going to pay the rent, but now you've got all these shareholders and investors that you have to, listen to and take care of. So, it takes a certain type. I think you have to have certain personality traits to be an entrepreneur and to be successful as an entrepreneur. But if you have some of those traits, I think it's a combination, then you can build on those and you can develop them. And I've seen, some really good entrepreneurs, come out of enterprise and things like that. But I think, if you don't have that, if you're not comfortable with uncertainty and risk, I think you're going to have a really hard time as an entrepreneur.
Yeah, makes sense. Adds up. Okay, to the second last question. This one's really dumb. So your company is bought, and you have the option of doing your earnout in either Toronto or Des Moines, Iowa. What do you choose?
Too bad.
Yeah, I think Toronto's quite neat, actually.
Yeah. Well, I guess I do have to say the business partner in my other business was from Toronto, and I spent a lot of time going back and forth there. So I'm actually, I would actually say, Toronto, better food, better bars, better nightlife for sure. They're both cold. They're both, the weather sucks in both places. So at least there you can get a better beer.
We don't have as much corn. I'll just put that out there. If you're like a corn lover, it's not gonna end well. That's so funny. Okay. And last thing I want to get to. Actually, I'll just say too. If you're ever up in Toronto, let's come up here. We'll have a beer and we can do the show live. It'll be great. But last thing is, so we've actually tackled a few startup myths. Is there anything else there that you really want to hammer home for our audience today? This will be our last question. So is there something that you really want the aspiring entrepreneur or the current entrepreneur to know that is like a surprising myth or something that is everybody thinks is true but isn't?
Yeah, I think that, what I've learned, as an operator and then certainly as an investor is, everybody sort of focuses on growth at any cost. And I think that is something that is misunderstood, certainly, and you're seeing it today, by the way. I mean, you're now seeing investors start to look at things like, profitability, making money, having,
wow,
all of those things. And there are very different dynamics that you need inside a company to, actually show profits and operating cash and all the other stuff, versus just grow.
Yeah.
And I think that short term, people are always, I started when I was at that first company as an equity analyst. So I started out like analyzing publicly traded companies and looking at, it from a finance perspective. And so, there are certain things that people would always point to and say, the public markets are screwed up because, everything is, quarterly earnings and you have to hit quarterlies and you have to do all this stuff to drive share price. But you see a lot of the same behavior in privately held venture-backed and investor-backed companies, which is they want an exit as quickly as they can too. And so you've got to show growth at any cost. And I can't tell you how many times that you go in and you just see that the company it's outgrowing either its culture or its systems or its ability to scale. And that will always come back to bite you in the end. I mean, you will eventually have to, there's this concept called technical debt. Like, I'm sure you guys are familiar with that. It's like,
well aware of technical debt.
Well, there's operational debt too. And that has to be paid back at some point in the future. And, I can give you anecdotes of, growing a company very fast from, some 85 employees to over 330 employees in, 10 months, 11 months.
What?
And some of the hires that we made, we just were trying to fill seats, were disasters, right? And we just, but there was an opportunity, and we thought, we got to go take it. So we went out, we hired. It was absolutely, we didn't care about culture. We just cared about, like, can you do the job? Good, sit there, get to work. And we ended up turning over, I don't know, I couldn't give you the exact number, but a lot of the people that we hired, because the culture was terrible and, it wasn't the right move. So I came up with this quick analogy, and then we can sort of end on this, or if you have any follow-up. But as I was looking at that, and that was so I had come in as an operating partner after making the investment to help this company grow. And, when we one of their problems was they had plateaued. They couldn't kind of get past this sort of revenue point that they had been at for about 20 months or so. And so that was kind of the opportunity we saw. But having gone through that exercise and then sort of taken a breath back, came up with this sort of like idea of like the scale machine. So if you like imagine like a conveyor belt going into like, you know, some machine, and whatever goes in one side comes out bigger on the other side, right? And that's basically what scale is, right?
Yeah.
So if you have, I don't know if you can, you know, I don't want to use foul language on here, but if you have sucky processes going in, you're just going to have bigger sucky processes coming out on the other side.
Totally.
And so it really behooves you. And I know it's not the sexy work. It's not the exciting stuff. It's not the, you know, the stuff that, you know, people, are think is great for marketing, whatever, but it's super, super important that you take the time to really, you know, before you start to scale, like there's this balance between get the product out, get product market fit. Don't be too, you know, we talked about it earlier, like don't worry about that last 5%. But before you start to scale, you need to take a look at what you're scaling and how quickly you're growing.
Yeah.
And sometimes you have to slow down to speed up. And, you know, it's one of those things. There's a, you know, this anecdote you read about cars, which is like, you know, we've had the ability, or, you know, well before now, like there was the ability for cars to go much, much faster than they were going, right? The problem was brakes. It wasn't engine. It was like, can you stop the car? Can you handle the car? It was steering. It was steering. It was braking. It was, you know, suspension. Like those were the things. Making the engine was easy. Like putting more horsepower in a motor is not a very complicated thing to do at a certain point, but the cars couldn't handle the engines. So the big innovation that led to faster cars wasn't bigger engine. It was better brakes.
That's cool. I love that. I think that's going to be in the title of the episode. That's great. I think that's really, really interesting, actually. That's something, you know, one thing that we had a guest and maybe this will be our final thought for today, but we had a guest a few weeks ago who, or maybe it was longer now, but a little while back, where they said, you know, a lot of people undervalue the importance of just consistency, of just being able to consistently deliver good quality and progress at sort of a, I was going to call it a healthier rate, and your business will do just as well, in some cases even better, if you just give the market the time to develop. Your personal stress will be less insane. You know, everything kind of works a little bit better once we kind of back away from this crazy obsession over growth for growth's sake. And so anyway, I love that. I think that's a great idea. I love the brakes and the engine. That's a cool. I will reuse that on another show. And thank you. And Rob, thank you so much for joining us today. Really awesome discussion, folks. That's another episode of Startup Different. We will be back next week where we go deep on this episode and talk about all the awesome stuff that Rob mentioned. And we will see you then. Hey, you made it all the way to the end of the episode. Nicely done. If you enjoyed this episode, like, comment, and subscribe wherever you get your podcasts so the almighty algorithm can help others find us. Want more from Startup Different? Check out our book, Startup Different, the myth-busting blueprint for your multi-million-dollar business. Follow us on social. We're big on YouTube, Instagram, and LinkedIn. You can also check us out at startupdifferent.com. Special thanks for this episode to Graham and our friends at Toronto Podcasts. Visit them at torontopodcast.ca. See you next week.